Well, let's put the focus on the capital goods space. Risk reward in the capital goods space is running low. This is according to Axis Capital's cautious view now. Sumit Kishore is executive director at Axis Capital. He tracks capital goods, power infrastructure at the sell-side house. Sumit, good to have you with us here, back on the program. Thanks very much. So tell us, why are you broadly cautious on the space? Is it largely valuations, or is ordering activity also starting to peak out a little bit?
Well, good morning, Prashant. Thanks for having me on the show. I think, one gets the feeling after looking at stock moves in the power sector and even across the broader industrials capital goods space that I track, we are behind, we have kept the sprint season is behind us. We are in for a marathon. And I think that the horizons for discounting cash flow are getting pushed back further into future. One is having to factor in higher option values for future growth opportunities to justify upsides on current price almost across the board. So there are stocks which we find are a bit overdone, but there are opportunities to, as generally happens.
Sumit, and you're talking about specifically the capital goods space, right? Not power utilities, or both?
Well, I was talking more at a broader level. In the capital goods space,
broader level.
For the last 7-8 quarters now, we have seen a fairly good run as far as order inflows are concerned. We've seen earning upgrades as a result of that, and order backlogs even till June quarter for almost 11-12 capital good companies aggregated, excluding L&T and the PSUs, was an order backlog growth of almost 24% on a year-on-year basis. So execution is likely to track well in the near term. Commodity prices have softened on a year-on-year basis. So gross margins are well supported if the pricing pulls up. And there are operating leverage-led margin gains which are benefiting, the EBITDA numbers now for the last few quarters. And if I look at the aggregate profit growth for capital good companies, it's been tracking above 40-50% over the last few quarters on a year-on-year basis. So earning upgrades have happened, but valuations for a lot of these companies have, run up beyond one standard deviation above long period mean. And that is making us slightly uncomfortable. Suppose you have a weak quarter on order inflows because with the commodity prices coming off, you have an adjustment in the value of contracts that the companies report for the same volume. You might have to sort of start looking at earning cuts for FY25 or 26.
I think that caution is taken on board, because even if you look at a stock like BHEL, right, Sumit, I mean, if you map a 5-year chart, it has done nothing for investors. 5 years back, it was at 70 rupees. And I think last year it was at 70 rupees. So it's only this year that it started to move a little bit. So for people who are perhaps holding on to these names, some of these capital goods companies that have, pressure on their working capital or on their balance sheets, what do you do? Do you take profits here?
I think, so BHEL is a case in point where for the last 2-3 years, there was hardly any award of fresh thermal projects. And now, over the last 12 months, you have had 2 coal-based projects of NTPC, totaling to about 2.9 gigawatt getting awarded. So I think there is definitely a finite capex cycle for thermal power projects that is going to be there, given the evening peak demand challenge that we are into. And over the next 3 to 4 years, that is just going to increase, given that the base load demand is also increasing. But I feel that the tariff of a new build coal plant has to be compared, with the price of a viable renewable round-the-clock solution. Till the latter becomes more attractive, the country will have to add fresh thermal capacity. And this finite phase where BHEL and L&T will see thermal contracts will definitely show up. On fundamentals, if you evaluate the NPV of this finite cash flow, and particularly for BHEL with a near zero or negative terminal growth beyond 2030, then it appears that the stock has run up, beyond fundamentals.
Okay, Sumit got that. By the way, the pre-open rates are in, And they're suggesting that we'll get a nice little positive start once again, about 50 up on the Nifty right now. Bank Nifty is up 0.25% as well. So let's see if this is how it plays out. In the pre-open, again, the mid-cap index is doing better than the Nifty. So lots of green as we start things off this Friday in all probability. Sumit, so like you explained, and I think this is something that that has become well known now, that because of this mismatch in demand and current supply and more thermal ordering, orders will perhaps keep coming. The question is picking companies which will have the best execution capability and, that run rate. That P&L run rate needs to come in as well. From that standpoint, which company stands out for you, where at least market might anyway be overestimating things, but I'm just saying, pure earnings basis, which stocks and which companies will stand out for you in terms of execution, bringing that to the revenue line, and then finally to the bottom line and EPS?
So I think in the broader capital goods space, we have a preference for L&T. We think that they have had a good run as far as order inflows for Q2 is concerned already, and with the deficient rains in August, execution would be looking up there as well. The commodity prices provide tailwind as far as margins are concerned, and over FY23 to 26, we expect core earnings of L&T in the projects and manufacturing segment to grow about 18% CAGR. So while valuations are looking high, we've been selective on the names that we want to push, and there are a few other catalysts which provide good news for L&T over the next 1 year.
Okay, so L&T is the top idea there. In your coverage universe, you began by saying that generally things have run up, right? Risk rewards have become a little unfavorable. What are the other top absolute return ideas from here, Sumit? Or you think it's kind of time to be a little cautious overall?
I think it is time to be cautious overall. Even in the power space, for the companies that I have been talking about on this channel, NTPC, JSW Energy, they have had very good runs when it comes to price performance. And one really has to factor in more medium-term growth opportunity to justify upside from current levels. So maybe you could have some sort of consolidation around current levels before you basically press the button to buy these stocks from near-term perspective. I think it's the marathon that we are more interested in now, that over the next 3 to 4 years, there are opportunities in the power space around the clean energy transition that we like. And likewise for capital goods, I think my experience in the last cycle was that earning upgrades continued between, say, 2004 to 2008. And if you purely sold the stocks on valuations, you would have gone wrong. So I think in this cycle too, the gross margins are well above where they were at the peak of the last cycle. And there is a big opportunity to improve margins via operating leverage if the top line growth momentum continues. And it appears to be broad-based as of now. While valuations are looking high, if earning upgrades continue, I think the stocks can remain expensive for a longer time as ROEs and ROCEs improve.
Okay, all right. Sumit, we leave it at that. Thanks a lot for joining in.